The $10,000 suit and ties of old Wall Street are being replaced by the up-and-coming new kids on the block. So today we're talking about some differences and similarities between ETFs, or exchange-traded funds, and index funds. The first thing that's important to know is that an index fund is actually either a mutual fund or an ETF. Index funds are not their own unique classification of investing vehicle, meaning for legal and tax purposes, they either have to be classified as an ETF or as a mutual fund. So commonly, when we're comparing ETFs to index funds, we're actually comparing index mutual funds to ETFs. So that's where we'll start today. The biggest difference between ETFs and index funds is how you buy them. See, index funds are traded exactly like a stock, meaning that you can buy and sell shares of them throughout the day during market trading hours, just like you would a normal stock. Index funds, however, are only bought and sold at the end of a day when the market close price is decided. This is why a lot of day traders and swing traders use leveraged ETFs for short-term positions because they can be traded during the day. Now, a lot of companies are starting to lower the minimum investment for index funds, but it still stands that to this day, ETFs are a lot cheaper to initially get into than index funds are. Companies like Vanguard and T. Rowe Price have a $2,500 or $3,000 minimum if you want to invest in their index funds, whereas with ETFs, in a lot of ways, you can essentially get the exact same thing, and you can start investing with as little as $1 on an app that allows fractional share trading like Robinhood. For difference number 3, we've got Mr. IRS, the tax man. ETFs are absolutely more tax efficient by nature. Because ETFs are traded like a stock, when you sell one, you're selling directly to another investor, so the cash is coming directly from them and the capital gains tax is yours to pay. But to get cash out of an index fund, technically you have to redeem it through whatever service is managing the fund, and then they have to go sell your stocks in order to generate the cash to pay you. And if this sale is for a gain, that gain is technically passed to everybody who owns part of that fund, meaning that you could possibly be paying capital gains taxes even when you don't sell your index fund. The last point that I want to hit on is that the cost of owning an ETF versus an index fund is essential to pay attention to. While many brokerages will offer ETFs for 0 commissions, you have to pay attention to a really important number called the expense ratio. There used to be a bigger price discrepancy in what companies would charge for an ETF versus an index fund, but now you can find both types of funds with really cheap or really expensive expense ratios. That's pretty much 1% of your return that you immediately have to give away. But if you find an index fund or an ETF that has more like a 0.02 or 0.03% expense ratio, that's definitely a better bang for your buck. So long gone are the days of some Wall Street bigwig with his $10,000 suit managing your money, and here's to the future of rolling out of bed every morning, throwing on a hoodie, and buying passively managed low-cost ETFs or index funds. And seriously guys, the only way we're gonna hit 100,000 subscribers by the end of the year is if you like this video, comment down below whether you like ETFs or index funds better, and make sure you're subscribed for all the awesome videos coming soon. It's totally free, it really helps the channel and tells all the algorithm gods to be like, hey, maybe some other people should be watching this video. Anyway, thanks guys so much for watching the video. Subscribe to the Wall Street Survivor channel, and I'll see you in the next one.